I'm Tom Udovich, a partner at Acadium Financial Partners, and today I wanted to discuss the old cliche and common disclosure on investment advertisements, which is past performance is not indicative of future results. Just recently, the Dow Jones Industrial has crossed the 40,000 barrier. While this is monumental and unprecedented, it's not uncommon for the market to hit new highs. What is common for investors to view market highs as a sign that stocks are overvalued or that there's nowhere to go but down. However, historical data on the S&P 500 index suggests otherwise. Let's break it down. Over a span from 1926 to 2022, about 30% of monthly closing levels for the S&P 500 were new market highs. What's surprising is that the average annualized compound returns after these highs were quite robust. 1 year later, returns were almost 14%, and over the next 5 years, they exceeded 10%. These returns were comparable to average returns over similar periods, regardless of whether the market was at a high or not. Looking at it another way, the S&P 500 was higher 1 year after reaching a new high about 81% of the time and 86% of the time after 5 years. This consistency suggests that hitting a market high doesn't necessarily mean that the market is overvalued or that it's peaked. Now that we have gotten all that supporting data out of the way, let's focus on another phenomenon, which is cognitive biases that enter the minds of investors when such events like these have occurred, which can detract from earning the returns that you deserve over the long period of time. One such mistake is to mistakenly assume that randomness means that past outcomes influence future ones to ensure a balanced result. Or in layman's terms, what goes up must go down. In behavioral science, this is referred to as the gambler's fallacy. The other mistake worth mentioning is assuming that randomness means that the success or failure clusters together, creating streaks that will continue indefinitely. The old adage on Wall Street states that trees don't grow to the sky, which means that good things will eventually level out or have a reversion to the mean. Behaviorally speaking, this bias is referred to as the hot hand fallacy. To be clear, we're not here to talk about psychology, but know that being a student of investing means that understanding past performance is not indicative of future results is so important in setting expectations. Maybe the statement is listed on so many investment disclosures for a reason. While we are all enjoying a new high on the Dow Jones and NASDAQ indexes, we need to be aware of how markets behave and your place in it. I was once told by a very wise person that the person that makes the least amount of mistakes wins. And as I get older and hopefully a little wiser, that statement resonates more and more with me. How we earn our keep at Acadium is to ensure our clients are educated in all things financial. Investing is emotional, to say the least, and it's the one category among all the planning items that requires the most ongoing reinforcement and maintenance, so we tend to address it often. For those watching that have been investing for a while, can you imagine how your lifestyle or the lives of others may have been altered had you avoided some, if not all, of these such mistakes? Let me list them. Misinterpreting randomness, as we discussed earlier. How about timing the market and chasing trends? We all know about that. Making false predictions, both positive and negative. Ignoring fundamentals and not thinking long term. Being mindful of additional volatility versus your own personal risk objectives. Being too concentrated in one sector or even one company. How about following the herd? Anchoring onto specific numbers like stock or index prices to make your buy and sell decisions. These historical patterns can help investors avoid knee-jerk reactions to market highs and stay focused on long-term investment strategies. It underscores the importance of staying invested, diversifying portfolios, and maintaining a disciplined approach, even during periods of market exuberance, such as we are in right now. By keeping a long-term perspective and not getting swayed by short-term market movements, investors can position themselves to benefit from the inherent growth potential of the stock market over long periods of time. If you'd like to see more content or on similar topics, you can subscribe to our YouTube channel. As always, thanks for working with Acadian Financial. I'm Tom Udovich.